Alright guys, let's dive deep into one of the most important shifts happening in our world today. De-dollarization. This isn't just a buzzword anymore. It's the reality shaping global trade, economics, and geopolitics right before our eyes. For decades, the US dollar stood tall as the undisputed king of global finance. It was the reserve currency, the settlement currency, the safe haven. But since the Biden administration, and even more so under Trump's aggressive trade policies, we're watching something historic. Countries, one by one, are actively moving away from the dollar. And every move away weakens America's grip just a little bit more. Now, we all know the early cracks in dollar dominance came with two big shocks. First was asset confiscation, Washington using the dollar as a weapon by freezing and seizing reserves of countries it didn't like. Second was the uncontrolled money printing spree of 2020, when trillions were unleashed into the system to keep the economy alive during the pandemic. These two events destroyed trust. Nations began asking, if our reserves can be frozen overnight, and if America prints money without restraint, why should we hold or trade in dollars? That planted the seeds of doubt. But today the storm is far bigger. We've entered a phase where tariffs, sanctions, and trade wars are accelerating the process. Countries that Washington targets are not just angry, they're being forced into alternatives. And India, the world's most populous nation, has suddenly been thrown into the center of this storm. Trump's decision to impose a 50% tariff on Indian exports came like a thunderbolt. No one in Delhi expected it. The entire strategic vision of Washington for years was about building up India as a counterweight to China. Military ties, technology transfers, shared intelligence, everything pointed toward partnership. And yet, with the stroke of a pen, Trump shattered that illusion. By hammering India with tariffs, the US has shown that no country, no matter how important, is safe. Today it's India, tomorrow it could be Brazil, South Africa, or even a NATO ally. For India, the consequences are brutal. Analysts estimate as much as 0.8% of GDP growth could be wiped away. Key industries like textiles, jewelry, and gemstones will be hit hardest. These aren't small niche sectors, they employ millions and form the backbone of Indian exports. Overnight, the competitiveness of these industries collapses in the US market. And here's the deeper danger. Tariffs don't just hurt exports, they ripple across the entire economy. The rupee has already fallen to a record low, spiking sharply after the tariff announcement. When a currency collapses, everything gets more expensive: imports, raw materials, energy. Inflation rises, purchasing power falls, and investor confidence evaporates. And that's exactly what we're seeing. In just 1 week, $500 million of foreign investment fled India's stock markets. Think about that. Investors are being hit on two fronts. On one hand, Indian companies face declining revenues because their goods can't compete in the US. On the other, the rupee is crashing, meaning even if you hold Indian stocks, their underlying value is falling. It's a double blow, and it's shaking confidence hard. Worse still, the rupee isn't just losing against the dollar. It's losing against the Chinese yuan. That's extraordinary. For years, India tried to frame itself as a counterbalance to China, but economically, the two are now tied in ways Delhi cannot escape. And here's the bitter irony. By punishing India, Washington is pushing it directly into Beijing's arms. Suddenly, old border disputes with China don't seem so urgent. Suddenly, Modi is planning high-level meetings in Beijing to repair ties. The logic is simple. India needs trade partners, and if the US slams the door shut, the only major player left to turn to is China. Now let's put this in numbers. Even before the tariffs, India was far more dependent on Chinese imports than people realized. Last year, India imported $125 billion worth of Chinese goods but only managed $18 billion in exports to China. That's a massive imbalance. And it's growing fast. India's dependence on Chinese inputs has jumped 76% in just 4 years. Electronics, machinery, chemicals, metals, virtually every sector of India's industrial base is powered by Chinese components. Without those inputs, factories grind to a halt. So if India wants to stay competitive, it must go deeper into China's supply chain, whether it likes it or not. This is the nightmare scenario for Washington. Instead of India becoming a counterweight to Beijing, the trade war has made Delhi more reliant on Beijing than ever. It's a complete reversal of US strategy. And at the heart of this reversal lies the dollar. Because when India buys more from China, the next logical step is to stop using the dollar altogether. Why settle in dollars when you can settle in yuan, or in rupees, or through BRICS payment systems designed to bypass the US? This is de-dollarization playing out in real time. Look at the trajectory. In 2021, India's trade deficit with China was $44 billion. By last year, it had ballooned to nearly $100 billion. At this pace, with Trump's tariffs fueling the fire, we could see that deficit hit $120 billion or more by 2025. And every dollar of that trade represents another opportunity to cut the greenback out of the system. Already, BRICS nations are settling more of their trade in local currencies. The momentum is unstoppable. Now comes the bigger geopolitical question. Will BRICS countries abandon Russia to please Washington? Will they stop buying Russian oil just because the US says so? The answer is a resounding no. The more Washington pressures them, the more they double down. Every barrel of oil bought from Russia in rubles, yuan, or rupees chips away at dollar dominance. This isn't just about funding Russia's war machine. It's about building a new world where the dollar is no longer at the center. And here's the climax. Putin, Modi, and Xi are scheduled to meet at the Shanghai Cooperation Organization Summit this weekend. Think about that. At the very moment Washington is trying to fracture BRICS and punish India, the leaders of Russia, India, and China are sitting at the same table, discussing how to deepen their cooperation. The symbolism couldn't be clearer. The more America pushes, the faster these countries move together. So let's connect the dots. Asset confiscation and money printing broke trust. Trade wars and tariffs are driving nations into China's orbit. Currency devaluations and deficits are forcing settlements in local money. And BRICS, instead of splintering, are uniting around a shared goal, building a system beyond the dollar. What we're witnessing is nothing less than the unraveling of US financial dominance. And it isn't happening slowly. It's accelerating right now in front of us. Right now, one of the biggest issues shaping global politics is energy. The peace talks between Washington and Moscow have gone nowhere, and neither side is making progress. Russia, instead of waiting, is pushing ahead with its next big move, the Power of Siberia 2 pipeline, designed to send even more natural gas straight into China. At the same time, Putin is determined that India won't cut back on Russian oil purchases. For both New Delhi and Beijing, the equation is straightforward. Do the economic benefits of cheap Russian fuel outweigh the risks of upsetting the United States? For China, the choice is obvious. Its economy is so deeply integrated into world trade, and so resistant to American pressure, that it can continue importing Russian crude without serious consequences. Beijing knows that Washington may protest, but it doesn't have the power to block these flows. And for China, affordable energy is essential. It fuels factories, lowers costs, and secures its role as the world's manufacturing hub. India, however, is in a more delicate position. At the moment, it brings in over 1.7 million barrels of Russian oil every day, more than even China. This supply is structured in ways that give India enormous advantages. Moscow accepts payments in local currencies, and on top of that, the crude often comes with a discount of 5 to 10%. That combination saves India billions while giving its industries a critical edge. But what happens if India bows to US demands and reduces its Russian imports? Any oil India steps away from won't disappear. It will be snapped up by China. That extra volume would strengthen Chinese industries even further, allowing them to undercut competitors around the world. Meanwhile, India would lose ground, becoming less competitive globally and increasingly dependent on the United States to buy its exports. At the same time, it would lean more heavily on cheap Chinese goods to meet domestic demand. That leaves India squeezed, trapped between two much bigger economic powers. Russia wouldn't be harmed much in this scenario. Putin knows there will always be buyers, whether it's China, Southeast Asia, or elsewhere. And China sees this clearly. That's why it is negotiating for even more gas through Power of Siberia 2, seeking an additional 6 billion cubic meters a year. The reason is simple. Natural gas isn't just about electricity. It's a raw ingredient for chemicals, fertilizers, and other products that form the base of modern industry. With cheaper gas, China can lower its costs, expand production, and export even more to the rest of the world. So, if India cuts back on Russian energy, the big winner will not be the United States. It will be China. Beijing strengthens its manufacturing dominance, grabs new market share, and leaves India struggling to keep up. Now, let's turn to Canada, because its story is a warning about what happens when a country leans too heavily on one market. For decades, Canada thrived as America's neighbor. Energy, lumber, metals, and other commodities flowed south, where U.S. refineries and consumers took them in. It was simple and efficient until Donald Trump changed the game. With tariffs and trade barriers, the comfortable relationship collapsed, and Canada's dependence turned into vulnerability. The numbers are brutal. Canada's GDP shrank by 1.6%, its first decline in nearly 2 years. Exports plunged by 27% on an annualized basis. Business investment fell more than 10%. For a country that thought the U.S. was a guaranteed partner, the reality is harsh. Being tied to one customer is dangerous. Yes, there are exemptions under USMCA, but they don't erase the damage. Ottawa is trying to pivot. Shipments to China are increasing, almost 300,000 barrels by mid-year. But this shift takes time. Infrastructure isn't fully in place, and there's always the risk of Washington punishing Canada for diversifying. In the meantime, the pain is unavoidable. The current account deficit has hit record levels, meaning more money is leaving Canada than coming in, not just from trade, but also from investment. If this continues, demand for the Canadian dollar could collapse, sending the currency down sharply. The only reason this hasn't already happened is because the U.S. economy itself is deteriorating faster, masking Canada's weakness. But this is no time for complacency. Even if Trump were to step aside, protectionism may remain. Tariffs could outlast him and become a permanent feature of U.S. policy. That means what should have been decades of slow adjustment must now be compressed into just a few years. For Canada, the latest figures are sobering. A 30% drop in exports during Q2, a $19 billion trade deficit, and falling energy shipments to the U.S. If the third quarter repeats the trend, Canada will officially enter recession. That almost certainly means more borrowing and larger deficits just to soften the blow. And this is only one country. Mexico, Germany, and much of Europe are staring at similar problems. This is the bigger picture. Trump's tariffs didn't just disrupt trade. They accelerated global shifts that were already underway. The world was moving away from the dollar and away from US-centered globalization, but the timeline has now been forced into overdrive. What should have taken 20 years may now need to happen in 2. Pressure is mounting everywhere. India must decide whether to keep buying Russian oil. Canada must break free from American dependence. Europe must brace for shrinking exports. And through it all, the United States risks being crushed by the very forces it unleashed. The boulder of disruption is rolling downhill, and while it will damage many economies on the way, the final impact will hit the U.S. itself. So the key questions remain. Will India keep importing Russian crude to protect its growth? How quickly will de-dollarization reshape trade? And how will Canada and others adapt to a world where dependence equals weakness? Share your thoughts in the comments, stay safe, and don't forget to like and subscribe as we continue to break down these turbulent changes in the global economy.